Good morning. We will pay attention to VAT today. First of all, we will look at VAT input. When we pay expenses or we purchase assets, the trader will be subjected to the levying of VAT. That means the price that you pay for the goods will include VAT when you buy goods or you buy any other assets. When you pay expenses, it will include VAT. But that VAT does not form part of the cost price of the assets or the expenses that you paid, because this VAT can be claimed back from SARS. So it means that when we pay expense, so for instance, water, electricity, telephone, rent, we have to pay VAT on that expense, but we can claim the VAT back from SARS. Therefore, it will not form part of the expense. We will take it to the VAT input account and create an asset to show that we can claim this money back from SARS, so there will be an inflow of money into the business. This money SARS owes to the trader because he paid it when he bought the goods or when he paid expenses, and this VAT input is therefore an asset that will be received back from SARS. Assets and expenses will exclude VAT. So in your ledger account, you can never have VAT included in your asset or in your expenses. Because we claim the VAT back from SARS, the VAT doesn't form part of the expense of the asset or the expenses that we pay. When we sell goods, we have to claim VAT on behalf of SARS. Or when we render services to someone else, on the services rendered, we have to collect VAT on behalf of SARS. And on any income that we receive, there will be VAT included that we have to pay over to SARS. So that means if you're a registered VAT vendor, so you're registered with SARS as a VAT business, you have to charge VAT on all the goods and services to your customer. So this selling price will always include VAT because we collect the VAT on behalf of SARS. This VAT doesn't form part of the income or the service rendered or the sales price for the business because you have to pay it over to VAT. This VAT collected from the sales or the income that's included in the selling price or income is called VAT output. And VAT output is a liability because we have to pay it to SARS. And the business owes this VAT to SARS. Therefore, the sales and income will exclude VAT in the ledger accounts because this VAT that was collected is paid to SARS. It doesn't form part of the income for the business or the sales for the business. At the end of the month, the balance in the VAT input account and the VAT output account will be transferred to the VAT control account. So all your VAT input total amount will be transferred to VAT control. Your total VAT output that you collected on behalf of SARS, that balance will go to VAT control. And then the difference between the VAT input and the VAT output is the amount that's payable to SARS. On the VAT collected from customers, that was VAT output, and VAT output is reduced with the amount of VAT that has been paid to suppliers with your VAT input. So if I take VAT output minus VAT input, I get the total amount that must be paid to SARS. The balance in the VAT control account will indicate the following. If it's a credit balance, it is a liability and it indicates the amount that's owed to SARS and that will be paid over to SARS. If we have a debit balance, then it means it is an asset, so then SARS will have to pay the money back to the entity. VAT input is VAT on costs. That means when we buy goods or we pay expenses, this VAT input can be claimed from SARS, and because it will cause an inflow of money in the future, it will be an asset. VAT output is included in the sales price or in income that we receive. This must be paid to SARS, and therefore it will be a liability. VAT payable equals VAT output minus VAT input. So if your VAT output is bigger than the VAT input, then it means that you owe money to SARS, then it's a liability. VAT receivable, when the VAT input is more than the VAT output, it will be an asset to us because SARS will have to pay the VAT back to the business. The amount that's payable to SARS is calculated as the amount of VAT that we received on the sale of goods minus the portion of VAT included in the price of goods when we purchase the goods. That means VAT input. So the amount that's payable to SARS will always be the difference between your VAT output and your VAT input. VAT output is a liability because the amount is owed to SARS. VAT output increases on the credit side because all liabilities increase on the credit side. The VAT output account will be credited when we sell goods for cash or credit, when we render services for cash or credit, when we recover bad debts because we wrote it off previously and now the people pay us, rent income, commission received, so on any income that we receive, settlement discount allowed that is cancelled on a RD check, drawings of inventory. VAT output will always decrease the amount that we owe SARS on the debit side because liabilities increase on the credit side and decrease on the debit side. That will be on discount allowed, bad debts, and debtors allowances. VAT input is an asset because this is the money that can be claimed from SARS. VAT input will increase on the debit side because assets increase on the debit side. This will consist on cash or credit purchases of inventories, consumables, stationery, packing material, cleaning material, any inventory that you buy. Cash or credit purchases of non-current assets, so on your fixed assets. If you buy any of them, you can claim the VAT back from SARS. The assets will never include the VAT in the asset account because we claim the VAT back from SARS. When we pay expenses, we will also pay VAT on the expenses, and this VAT can be claimed back from SARS. VAT input will decrease on the debit credit side because it's an asset. Asset increases on the debit side and decreases on the credit side. So creditors' allowances and discount received will decrease my VAT input. VAT exempted items is rates that you pay on your property because it is a tax already, so you don't pay tax on tax. Salaries and wages because you pay as you earn. Interest is not taxable by VAT, so it's an exempted product. Petrol, there is a lot of tax on petrol already, that's why we don't pay VAT on petrol. Entries that have no influence on VAT. If I invest money or that fixed deposit matures, it means I move my money from one account to another account. If I obtain a loan or I pay back the loan, it's a movement of money from one account to another account. When we sell the goods to the debtors, we already record the amount that we have to pay for VAT. So when they receive it, we don't show the effect on VAT again. And when we pay money to creditors on the money paid, there will be no VAT. If discount is allowed or received from creditors, it means that on the discount amount there will be a VAT effect. Drawing of money for use by the owner. So if he takes his own money out of the business, it is not taxable. But if he takes goods out of the business, he has to pay VAT. And on capital contribution that he donates to the business, no VAT.